Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens? Not any more. The key reversal down last week put paid to that. It seems the move below 13 even, which was mulled over for quite some time, has reached the conclusion, at least for now. The reason this seems likely is that on Tuesday this week we had a smaller reactionary combined key reversal up and bullish engulfing pattern in response to the earlier and larger key reversal down, daily key reversal down we'd seen this time last week. It was a well-based reaction with the base of the action built up from the support of the big 50% Fibonacci line of the April 2020 to May 2021 move at 1243. However, yesterday's response to this overtly bullish reaction was to make an immediate countering bearish harami. And today, whilst not necessarily a complete follow-on lower, is certainly not inspiring to any bulls out there. So let's look again at what the larger picture shows. Now, I said 9 weeks ago here how I'd noticed two new possible patterns, not necessarily complementary. The first was a mid-June to mid-August ascending triangle. The flat topside trend line was capped by the resistance at 1459, whilst the broken rising mid-June today uptrend, currently at 1422, is the lower trend line. By late August, the market broke down through both the long moving average, currently 1390, and also the lower trend line. It is at this point that I'd like to mention once more the second related pattern which I'd seen. The bearish halfway hesitation that takes the action from early to mid-June, making a left flagpole. Now, the market has in reality made not just a bit of a mess, but it made a real mess of the right-hand side flagpole for this pattern. In part, probably a large part, this has been due to the clash with the ascending triangle pattern. Nevertheless, prices have or had moved lower down through the lows of June and back in late August, reaching the old target X again in the 1290 area, and back again in late August reached the old target X again in the 1290 area. This was the original primary target for the ascending triangle, and this is where we've been held until late last week. So what's next? Well, it seems reasonable to look to the downside. So below we've had for a few weeks now two key potential targets. Target X1 is a secondary target for the ascending triangle in the 1202 area, and target X2 the first possible ragged bear flag target in the 1178 area. The problem has been, and still is, what we saw touch this past Tuesday for the first time. In between where we are now and the targets below, we have two key 50% Fibonacci supports. The one already mentioned, which was touched for the April 2020 to May 2021 move at 1243, and the other slightly lower one for the 2019 to May 2021 move at 1229. These 50% Fibonacci lines are quite new, only finalized back in May this year. But they are still there, and at first touch they have rejected. First one did anyway. They have rejected any declines lower. Looking around, there seems to be limited supports below until the 1140s. As for the top side, well, the declining short medium moving average, currently 1311, is the first obvious choice and is coming fast into the frame of the market. However, I suspect the long moving average, currently 1390, as a possibly better resistance top side, especially as it crossed, though not a golden or dead cross, as it crossed over with the declining medium moving average, currently 1363. Though it seems reasonable to look also to this medium moving average now as the next topside resistance as well. Okay, so I would normally leave it there, except I had back in early September a short and very interesting conversation with Andre Sheckman in Brazil, a very good friend of mine and also a technical analyst. He asked me to look at the whole of the 2021 here action here as a possible head and shoulders top. And I have to say what he has asked does indeed have merit. Now I will continue to ponder upon this further, as the action does not have as clear a neckline as I would like. But I can say this: the market was hesitating and seems to be finishing this hesitation now right on in the area a neckline would be drawn. Continuous caution is therefore still advised, but only for now. Chicago soybean meal. Now, I wrote some 13 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that," end of quote. What I wanted to emphasize at that time and every time since, including now, is that everything since May has been in the shadow of that singularly bearish pattern. With this in mind, it brings into perspective the breakdown in June through the long moving average, currently 390.40, and a drop down to the lower time, currently 288.80, with a bearish 2021 Andrews pitchfork. The subsequent bounce up only ended in the market going sideways throughout July and August, and also running along the underside of the middle time, currently 335.10. Now, as part of this action, prices created a lower trend line, currently at 344.60, and thus the market drew a descending triangle pattern over July and August. In late August, prices punched down through the lower trend line of this descending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag seen during May and June. However, when prices dropped down 3 weeks ago, the market must have felt that it was also too far away from the comfort of the middle time, and prices moved back towards it. However, Thursday last week, prices finally took the plunge lower and punched down through the middle time. Target X as well, the low of early September at 332.50, and made new lows and low closes, not seen since September of last year. Monday of this week, prices finally reached down to target X1, the initial target for the descending triangle, in the 326.10 area. A secondary target X2 now lies a little further below in the 306.80 area. I should now point out the caveat that secondary targets are far harder to achieve than initial ones. As a semi-final point, I would like to once again recognize the wonderful job the bearish Andrews pitchfork for 2021, overall originally drawn back in May, has done in its overall task of channeling the market lower. It has been useful and valid up until this very day and seems likely to be so for some time forward. This is the key to the market here. The bearish Andrews pitchfork, when it finally gets busted or adjusted to a bearish shift pitchfork or some other pattern, then we can look for new ideas. But until then, the bearish incentive is still run and ruled in this market by this same simple bearish Andrews pitchfork. And as I speak today, we are on the verge of possibly making an immediate countering key reversal down possibly, and with a new low as well, and moving towards X2. But we'll see. Chicago soybean oil. For months now, I've highlighted the rather lopsided diamond pattern seen over May to July. Looking again today, I still find it to be the one key pattern here, but it has some other competing patterns now. A few words now again on the diamond pattern. Diamond patterns can be tops, bottoms, or continuations. In this particular case, it is a top. Back in late July, the market broke down through the lower trend line, but it did not immediately follow through lower. Instead, the market chose to run along the underside of the broken trend line. This stopped when the market reached the right-hand side apex of the diamond at the end of July, thus providing additional bearish pressure to the diamond pattern's breakdown, making it a genuine action. Anyway, prices dropped, but then came across an obstacle. The medium moving average, currently at 61.38, and halted for a while in early August. By the middle of August, prices had overcome this obstacle and continued their journey lower through the congestion zone between 57.64 and 59.44, which you can easily see in the striped band across the middle of the daily chart, and punching down through the lower trend line, currently 53.69 of the July to date descending wedge pattern. Now, prices tried exploiting the breach, but all that was managed was an additional, if short, bear channel over mid-August to late September. 2 weeks ago, they met a pair of obstacles on their way lower still. The rising long moving average, currently 56.08, and the 50% Fibonacci line for the whole of the 2021 action, so far at 55.43. Now, prices managed 2 consecutive closes below the 50% Fibonacci line, if only just on the second day, but there were no closes below the long moving average, despite 2 days of breaching. Consequently, prices move back up again within the new small bear channel and also the original descending wedge pattern, and most recently over the previously mentioned congestion zone between 57.64 and 59.44. In this process, the market is now punched up and out of the descending wedge pattern. The most recent efforts have seen prices move up and close over the declining short-medium moving average, currently 59.90, and challenge the slowly declining medium moving average. That's currently at 61.37 above. In this process, we've seen prices over the medium moving average but not close over it yesterday, and yesterday was a tempering bearish dark cloud cover pattern type action, moving the market back below the 2011 high at 61 even. Nevertheless, we now have a potential target X2 in the 66.80 area above the market with a recent descending wedge pattern on the upside. Now, I know this is a big ask, but unless this is a false break on the upside, that is what the potential target may be on the upside. Anyway, just in case, I have as an alternate to this new concept two targets below for the diamond pattern. The initial target X in the 55.90 area and has been achieved. We still also have a secondary target X1 in the 53.80 area. As you are no doubt aware, secondary targets are much harder to achieve, so I'm not holding my breath over achieving target X1 below the market, especially as the gently rising long moving average has apparently put paid to ideas of heading lower. To be honest, achieving primary target X1 on its own, X on its own, was a big win, and going the extra bit to reach target X1 is not essential. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. And here comes the final bit.